Hi everyone, welcome to the 2022 October 2022 budget. So obviously the budget came out last night, and we've spent part of today working up a document that we'll get out to you guys pretty shortly. But what we want to do now is just take you through some of the pertinent points around what that budget looks like, and particularly from our clients' perspective, anything that they can take advantage of. So Shane, welcome. I know you've spent a fair amount of time putting this document together. So do you want to share your screen and we'll take everyone through it?
Thanks, Cam. Yeah, I think it's always interesting budget night. I mean, obviously the money nerd comes out, and watching the budget is always a bit of fun. But I think above all else,
did you stay up?
Well, it started at 7:30. I don't go to bed at 7:30, so I did watch the budget. Yes,
you did. Yeah, right.
But I think, from my observation, and we'll get into some of the nitty gritty in a moment in regard to the actual regulatory change or the policy change. But what I think is interesting is the assumptions that come out of the budget, because we often hear about inflation, GDP, are we going to have a recession, those sorts of things in the media all the time. But it's only once or twice a year we actually hear it from the government in terms of their thinking. And, from a headline point of view, the government's forecasting inflation will peak at 7.75 in December, which is a very, very high number, of course. But
number, isn't it?
It is. And today inflation was slightly higher than what was expected by, I think, 0.1 or thereabouts was slightly above forecast. So maybe this number already might be a bit out of date, but we'll see what happens. But I think the interesting part, however, from my observation here, is that they're not forecasting a recession in the next couple of years, which is contrary to what the headlines in the media are suggesting. I mean, you'll note here, GDP growth to decrease to 1.5% in 2023-24 financial year, but nothing to the effect of a recession. I'd certainly be curious to hear your thoughts on that, guys.
Yeah, no, look, that's right. I suppose we need to. It is a forecast, so let's and it's the government making a forecast, so let's just put that in perspective. But it's promising, right? So it kind of looks like that retracting to 1.5 still positive, isn't it? So we will see, won't we?
Definitely feels a bit more sensible than our inflammatory media organisations like to portray. That's for sure. So
yeah,
something it's I think people should be cognizant of.
I thought the interesting one too was their forecast around unemployment rates. They're expecting unemployment rates to be, I think it was coming in just under 5% by the end of the next 18 months or so, which seems odd because it seems everyone I speak to at the moment, every one of our clients, everyone in industry is struggling to find people and find staff. So I've sort of found those 2 points conflicting in terms of what they're forecasting versus what's actually happening in reality in the marketplace today. But again, it's a forecast and we'll see what happens.
Still a pretty positive number though, isn't it? Anything under 5% is, from an unemployment perspective and a growth of the economy perspective, is still a pretty strong number.
Yeah, well, I think the stat was it was still lower. I think it was 4 point. I think they were forecasting at 4 point something percent, which just before COVID that it was sitting at 5%. So it's still going to. They're still forecasting to be lower than pre-COVID unemployment rate, which is pretty healthy.
That's right.
Indeed, when thinking about some things that are out there healthy and sensible, I feel as though overall Jim Chalmers, I think, produced a fairly sensible budget in this instance. He didn't sort of rock the boat too far, and he didn't sort of put out there anything outrageous at this point in time. And I think very much lays a platform for what we may see in May next year as they start to tackle some of the budget deficit that we have got. But if we can pick up a couple of things that did come out, and we'll focus on those that are sort of pertinent to individuals and investors to start with. And then perhaps, Luke, I'd be really keen to hear your views from a business point of view and a tax point of view as to some of those sort of key changes out there. But I think this is probably for mine those share buyback change that it's often one of those points that are missed by many, and it's particularly pertinent to investors in self-managed super funds, in that buybacks of companies when they buy their shares back off of you, they normally make it enticing enough to sell them back to them because they give you a pretty healthy franking credit and dividend as compared to capital. So for those in super fund pension phase, obviously those pension credits or those franking credits come all the way back into your cash account. The proposal here is to abolish those entirely and treat buybacks as though they were sold or bought on the open market. So they do think that's going to produce about 550 million to the budget bottom line. But fellas, that's probably one of those things for SMSF investors that we need to be mindful of moving forward, because I think overall it's a fairly common sense kind of change. It's trying to tackle some of those areas that is maybe low hanging fruit, but it is a change nonetheless that some people will be having to be mindful of.
Typically, when those buybacks come through, they're typically only worthwhile because of the amount of franking credit. So it's going to be interesting. We'll have to obviously treat them one by one as they come through, but it'll be interesting to see what they actually look like when they come through, because typically they're only worthwhile for those investors in pension phase.
And also, I think too, and I think also to the fact of companies build up surplus income and profit, and they want to do something with it. So we may see a bit of a change in direction in terms of paying out dividends as compared to these very enticing, buybacks in the future.
Yeah.
Downsizer, Chris, what are your thoughts on that, mate? 55 is now the new downsizer.
New 60, yeah. Going backwards instead of up.
Yeah.
Yeah, look, I think it's it just gives some more flexibility, definitely. But like we've had a bit of a chat about this prior. There's some complexity in there in the sense that if you decide to do it at say 55 or 56, maybe even 57, you've got a few years of before you can actually get access to those funds. So whilst it increases the scope of those who are looking to downsize, which how much impact this might actually have on housing stock, I'd be a little skeptical. But look, nevertheless, this is the new legislation going forward once it's past royal assent. But just I guess the impact of that being, if you're doing it pre-60, there's you can't get access to it prior to that. I think it's just something that everyone kind of needs to be aware of.
I suppose the other thing on that too, Chris, is once you've used your downsizer contribution, you've used it.
Yep.
So you can't use it again. And so, I know we don't really intend on moving our house, but it does typically happen that people tend to move out of their houses. Is it every 7 years, I think, or every 10 years? I can't remember now.
Not sure.
And so maybe we'll look at it obviously for each client, but maybe there's an opportunity to use the non-concessional contributions instead.
It's an interesting one, isn't it? Because the life stage aspect of that, where typically the downsizing, well, I don't know, you guys might have a different experience to me, but typically the downsizing is for freeing up of capital to provide, I guess, a longer time frame of financial retirement capital, and usually that's when we're starting to run out of what we've built through our working lives. So dropping it earlier, if you were to do it earlier, as you said, Cam, you use up that option set for potentially down the path when you say 75 or 80, and under current rules, then you can't get any more into super because you can't make non-concessional contributions post 75. So it's it's an interesting one, definitely one to I guess not just be open slather and blasé about how you attack it from a strategy standpoint.
No, that's right.
Gives people some flexibility, doesn't it, in their sort of life planning, which is great. Hey, Luke, SMSF audit requirements have shifted back to once every 12 months instead of the thought of maybe every third year. I must say the cynic in me says that the benefit of this was going to be maybe a reduction in price, but most auditors would have charged 3 times every third year for the audit. But I don't know whether it's a good or bad change. What's your views on this one?
Look, I'm in split minds about it, because I certainly think there are funds out there that are doing all the right things and really probably only need to be audited once every 3 years. And in that point too, if there was funds that had property held within it and stuff like that, you could do revaluations at that point too. So they're all sort of aligned. But the cynic in me also thinks there's plenty of people out there that would come up with strategies to try and rort the system. Money's coming out of super and then going back in between the two time frames, so you wouldn't actually ever pick it up without doing a full audit on all 3 years at that point in time. And to your point, I think the auditors just charged 3 lots worth of audit fees in that 1 year, which would certainly make it hard to manage your business from a cash flow point of view if that was how they had to start operating. The other one I thought that was interesting too was the delayed changes to residency and control over super funds.
Yep.
I'm not sure whether or not that's just purely an administrative thing that they didn't think they could push it through and get royal assent quick enough. But it's an odd one that they've delayed that too now from, I think it's now going to be the first income year after it receives royal assent as opposed to starting from 1 July. So that was just an interesting one. It's not overly, I suppose, not probably that common that we have clients impacted by it, but we do have a handful of clients that have recently relocated overseas for work, and we've had to then either bring in a family member or something like that so that control can remain in Australia if the time frame exceeds that 2-year period to be outside of Australia. So that was an interesting one. There wasn't a heap, I didn't think, for businesses like we've seen in previous years where they've really ramped up the instant asset write-off and trying to give small to medium businesses a pretty big carve out on that front. It did sort of feel like they felt they've done what they can for small businesses the last couple of years, and a lot of those measures are still in play, which is good. There's a few energy efficiency grants that'll be interesting to see what rolls out with them. I think it's an awesome initiative if small business has some incentive and some help to be able to go green
Absolutely.
as much as possible. I think it's something that we should all be looking to do. But what seemed to be pretty evident here is that the large gap in the budget, they're going to certainly try and fill that with tax collections. So obviously tax revenue's up because we've had inflationary pressures push pricing of things up. So GST and things like that naturally have increased the government's revenue on that point. But they seem to be throwing a fair bit of money at audit activity, their cash economy and those kind of things. So it did read to me that they're going to ramp up audit activity in that space to try and claw back some of the revenue on that front.
So did I read that it was going to be, they're expecting to claw back $2 billion in revenue for spending $200 million?
Yeah, I think that was only under the anti-avoidance provisions as well.
Was it?
So that's not including going after multinationals and things like that. And yeah, they're going to scrutinise deductions claimed in tax returns a fair bit closer.
Yeah.
So
no more cash in hand payments.
I think, Luke, you're going to have your hands busy this year with tax season from an accounting point of view, that we all love getting tax deductions as much as we can, but maybe you'll have to act as a Grinch this year and sort of rein in our expectations about what we can claim in our tax returns.
Yeah, look, we're fortunate. Our client base is pretty good. So, but there's certainly some horror stories you hear of things getting claimed out there. But look, one thing the government has done over the last sort of 5 to 10 years is they've really ramped up their data matching ability. So every tax return that gets lodged gets run through their algorithms to flag where it should be sitting in a benchmark, and they'll benchmark your tax return against every other tax return in that industry. So they have really increased their back office ability in terms of flagging potential issues and then being able to hone in on them. So that and the added funding towards that, I think they'll certainly be ramping up the activity in those spaces.
Hey guys, one thing I did forget to mention before and I thought was interesting was that, and not to digress away from the very interesting stuff of tax, Luke, but I did see that there was a bit of an incentive for self-funded retirees who may be able to get a Commonwealth Seniors Health Card for the first time, with an increase in the income test from about 90-odd thousand to 140, 145,000 thereabouts. So that's a little bit of good news for self-funded retirees.
Definitely.
Yeah, pretty significant. As we all know, we've got quite a few clients in that boat, and fairly well every time we do a review or we do a progress meeting, it's something that comes up. So I know from my client's perspective, we'll start working through that as that's given royal assent. But I haven't actually read that part. Is royal assent?
I think it's imminent because I think it was proposed a little while ago.
It was, wasn't it? Yeah.
But so I think it is actually quite imminent now to actually being passing. My read on it was that it was actually going to be passed fairly soon as legislation.
The other thing on that front is the deeming rules.
Yes.
So they've been frozen, haven't they? So even though cash rates are increasing, which we'd typically expect to see an increase in the deeming rates, they've been frozen for the next two financial years, I think I read.
Yeah, and in 2024. So
Yeah.
some good news again, and particularly in regard to this Commonwealth Savings Health Card as well, because it's a deemed calculation. There's no asset test to it. So yeah, certainly that will help some people in the And last thing I had from my end, actually, interestingly enough, is trying to address the skills shortage out there. There is a little bit of a incentive for people who are in receipt of government support in their retirement to have a $4,000 work credit not a payment, but an income test exemption to earn some money without impacting their pension. So, I think it's maybe a sign of the times in regard to where we're seeing, that low unemployment rate before and needing to fill the void of, that unemployment rate.
I was actually hoping that. Sorry, Cam. Go.
No, Chris, you go.
I was just going to say, I was actually hoping that was going to be more generous than what it was, because that works out to be like $153 a fortnight. So, if you're looking to use your skills in the economy in some way, what does that work out to be? Like 2 hours a week, if that? Like it's a pretty meager. Pretty meager allotment, I suppose, if you're looking at getting paid. And if you go over that mark, well, then your pension starts getting reduced. I would have liked to have seen more incentive there, but some's better than none, I suppose.
Can't argue with the point.
Last one I had was electric cars. So the FBT, Luke, you'll be able to explain to us how that works. The FBT amount on purchasing a vehicle has been wiped. So I think if you do it through an employer, you can salary sacrifice for the cost of the car, and then subsequently you're not having to pay the FBT amount, which is top marginal rate.
Yeah, it's interesting, that one. I'll be interested to see how that plays out and what constraints are around that. I did have a giggle though after they said electricity prices are expected to go up 30% in the next 12 months, and then rolled out an incentive for everyone to get electric cars. Great. But look, again, another initiative where they're trying to benefit people that are making an effort to go green. So it'll be interesting to see what they do around the limits on those cars and what cars qualify.
And also committed the funding to have power stations. I think that's one of the things I've always observed is electric cars are fabulous, but at the moment it's still very infant in its rollout because we can't charge our cars readily enough. So at least it's been supported with funding to improve accessibility to charging stations.
I think it was at 117 they've committed to building around Australia, another 117 fast charging stations.
I think there needs to. No, it's so negligible. I think there. Well, again, and this is maybe Shane to your point in terms of next year, really ramp that in with some sort of like joint venture with for-profit enterprise potentially to sort of start working on this sort of stuff, because it's not that electric car industry is not going to take off like everybody wants it to, I suppose, until that infrastructure is in place. Anyway, let's see, hey?
Yeah, but it'd be interesting.
Well, I still don't have an electric car. I'd like to get one, but there's this dichotomy around how many kilometres it goes before you actually have to charge it again, and then I think it's 12 hours charging or 14 hours charging or something to get a full recharge at home. But if you go to the charging stations, it's 20 minutes, so that's negligible.
Yep. The full electric cars are actually also quite expensive relatively to, and I'm sure that will shift. But the hybrids are cheaper. But then if you actually look under the hood at the metrics of like kilometres on electricity versus kilometres on petrol, the percentage weighting is pretty skewed still heavily to petrol outcomes. So yeah, anyway, look, there's, as you said, Shane, infancy, right?
Indeed. I've got nothing else, guys. We'll be interested to see what happens between now and May, I think, is the watch this space, I dare say.
Yes, agreed. All right, brilliant. Thanks, guys. Thanks for listening. We'll put something together and it'll come out in due course.
Bye for now.
See you later, everyone.
Ciao.
Bye-bye.
See you guys.